It's a pleasure to be here today. And I must admit, this is the first time that I have actually talked about this in this type of a format. So if I go too fast, if I am not good at explaining, please forgive me. But I do have some experience because some of this material is what I have used when I taught a class at Chulalongkorn and also a class at Mahadhan University here in Thailand. And I regularly teach a class in Munich, and I use some of the same material, most of this same material. So you're actually going to get material that I use in universities to give lectures to undergraduate students and to master's students. If I speak too fast and if my English is not understandable, please, I apologize. But let's try and get through together. I hope that you learn something, and equally as much, I hope that you're entertained and you find this a useful session. I'm going to talk about managing the value of an insurance company. And I'm going to try and do that in 2 hours. And I'm going to focus on property and casualty and life and health because we are, after all, a multi-line insurance company. We do both types of business, both segments. And I'm going to talk about, in some sense, the theory of managing the value of an insurance company. And I put together one slide as an overview that I'm going to keep coming back to in order to reinforce the same message. And that is because if you understand something about the mechanics of insurance, managing for value is relatively simple. And this is my overview, and I'll come back to this many, many different ways, right? The first concept, now I have to find myself on the screen. Okay, I'm over, yes, now I understand. The first step over here is to generate profit. That's the first step, right? And I generate profit by doing good technical underwriting. This is the work that in the country health team is done by the underwriting team in property and casualty. It's the specialty lines underwriters combined with Radar Live for the automotive book, etc. So understanding what risks at what price to set. That's my technical profitability. The second element is expense management. I have a certain amount of expenses in terms of acquisition as well as in terms of administration and other expenses. I have to be good not only at technical underwriting, but also expense management. And the third is because we accept premium up front, we need to invest it. We accept premium up front and we have capital, we need to invest it. And so investment margin and asset liability management is absolutely critical for success as well. These are my profit drivers, and you'll see this in the financials for Allianz, which I will show you. Technical underwriting profit, expense loading profit, and investment income. Those are my three sources of profit. Let's suppose, I'm going to drop my paper. Let's suppose that we are good at generating profit. What's the next step? The next step is to decide what to do with that profit, right? So every time I generate profit, suppose I generate a return on equity of 10%. If I generate a return on equity of 10%, I can actually, that's additional capital. That means I generate earnings 10% of my existing capital base. So I generate more capital. I can do a couple different things with that capital. I can grow my business through good sales and distribution. That's one source of a use of capital that I can do. Right now, Allianz Ayudaya, I think, is running at 13 to 14% in the last couple of years, taking out AZAY, taking out one-offs. I think we're running at about 13%. So we are actually, we're growing by about 10%. So we are taking some of our earnings and investing it in growth. But if I'm earning 13%, 14%, 16% capital or earnings, and I'm only growing by 10%, I can obviously give some of my capital back to shareholders or some of the earnings. So Allianz Ayudaya, AZAY actually pays a dividend every year to shareholders. And then finally, I can use this additional money, this additional capital that I've generated through good profits. I can use that to improve my balance sheet. I can increase my capital ratio, my solvency ratio, etc., if I want to be more conservative. So again, the first step is to generate good profit, technical underwriting profit at a good expense ratio and investment income. I'm going to take that profit and I'm going to decide through capital management what to do with it. I'm going to plow some back and grow my business profitably. I'm going to give some back to, this is complicated. I can give some back to shareholders as a dividend because shareholders expect to be compensated. And I can also use that excess capital to adjust my solvency ratio. This is capital management, and this is a core element of managing value for an insurance company, capital management. In addition to technical underwriting, expense management, and investment management. And then the final step is for every amount of money that I plow back to grow my business, I need good sales and distribution capabilities. This cycle repeats itself every single year. Every single year. We want to make good technical profits. We want to do good expense margins. We want to get good investment results so that we can grow our business. We can give money back to shareholders and start the process all over again for the next year. That, I could stop the lecture right now. If you get this, I could stop the lecture right now because it's as simple as that. I need to be good at underwriting health. I need to be good at underwriting motor. I need to be good at underwriting automobile. I need to be good at underwriting. I need to do so at a good expense base to be efficient. And I need to earn a decent return on my capital and my reserves through investment. And then I need to make sure that I'm using that capital effectively, growing the right businesses, giving back to shareholders, and finally, I need good sales and distribution capabilities in order to repeat that cycle and make sure that I'm growing profitably. That's in a nutshell. And if I was a comedian right now, I would drop the mic and get off the stage. It would go boom, and that would be it. But I'm not a comedian. I'm just a poor CEO. And so what I want to do is I want to go into a little bit more detail. But I'm going to come back to this picture many times during the course of the next hour and 45 minutes and repeat the same hopefully simple message about what does it take to create value in insurance. And I'm going to do so by first focusing on property and casualty, then going to life and health, and then I will talk a little bit about managing for value. And at the end, if time allows, I'm going to give you some thoughts on personal development. Okay, let's start with property and casualty. I want to start by giving you a little bit of history, and I'm going to go back incredibly far. So picture 20,000, 10,000 years ago, our predecessors are sitting in a jungle or in a floodplain here in Thailand, and I may have many different houses in a village. And what do you think would happen if one of those houses burned down? Do you think that the rest of the village would chip in, try to support the family with food, try to support the family in rebuilding the house, etc.? So what is that? What happened there? There is a property damage, and a collective of individuals came in to support the poor person who had their house burned down, to support them in their time of need. This is essentially just like insurance. During a time of need following a property damage or some loss, a collective or an insurance company in the modern days will step in and support. But 20,000 years ago, the society, if you will, the collective, the village, would provide that support mechanisms. If somebody got injured and broke their leg and could not hunt or could not gather food for the next 3 months, the village would support them. If somebody's house burned down or if their ship got burned and they could no longer fish, the collective would support them. Risk sharing within a collective for property damage is as old as humankind, right? And it tells you the value of risk sharing within a collective, right? It's been around for a long time, and the reason why it's been around is because, quite frankly, it's very, very useful. And I want to give you the message that property insurance in general, is very, very useful from a society's perspective. But this type of collective risk transfer has changed radically over time. And if you look at it historically, the most, going back as far as I could, a big radical documented change is actually happened during 1750 documentation, the Babylonian Code of Hammurabi. Now, Babylon was in the Middle East. It was one of the first societies that developed a cuneiform or writing. And they, in the Code of Hammurabi, which is a codification of rules and of tax treaties and of commercial contracts, etc., they wrote down that a merchant that was financing a shipment could pay an additional amount of premium to cancel the loan if the ship was stolen or lost at sea, right? Now, this sounds incredibly similar to marine and marine cargo, marine hull and marine cargo insurance, right? So you pay a premium, and if the ship is lost or stolen or damaged, etc., you get compensated. Now, the key difference here is that this contract term was associated with the financing. It was not a separate contract. Insurance as a separate contract, a standalone contract, standalone and independent from financing, didn't come about until right about here in the 14th century in Genoa. Genoa was a major trading hub in Italy, around the Mediterranean. And this is the first time that insurance policies were not bundled with financing. So you see already that the development was from quasi-collective, but why wouldn't a collective work well with regards to ship financing and trade financing? Simple reason. As the ships get bigger and bigger, the amount of value on that ship becomes enormous. The ship has value. The trade in materials, that is, the goods that are on that ship, has value. Suddenly, small collectives can no longer handle it. You need to disperse the risk even further. And so financial contracts that share risk, as opposed to collectives that share risk, financial contracts that share risk typically share them on big value things. So you begin to see in property and casualty insurance develop for high value tickets. It starts to be part of the financing because the financing of trade is very, very costly. And then over time, you begin to be able to separate out the financial contract from the insurance contract. Now, in between, I think it's something very, very interesting. In between, they actually started the same types of maritime loans in 400 BC, before Christ, in Athens. They did the same type of financing that the Babylonians did, but they differentiated the pricing depending on whether you were going to trade during the storm season or whether you're going to trade during the summer. Right? And why? Because storm seasons, obviously, you lose more ships. And so the price should be higher. And what is this? This is a type of underwriting or actuarial pricing that went into it. And it's interesting to see the development. Now, what was the next big store of value for human beings? The next big store of value, if you will, was probably homes, right? And if you look over here in the 1600s, home insurance started. Now, why did home insurance start? Very simply, it started in London because in 1670s, you had the Great Fire of London. And at the time in 1670, the homes were built so close together that once one burned, the neighbor burned, the neighbor burned, the neighbor burned. 25% of all the homes in London burned out, right? The fire equipment wasn't sufficient. And they lived through this, the Great Fire of London in the 1670s, and they said, my goodness, this is too much risk. So what we'll do is we'll create an insurance company that is focused on homes. Now, why homes? Because there's a significant amount of value in homes, right? After maritime and commerce, then homes were the next big asset accumulation. Then you begin to see fire companies extending into the United States, etc. The general principles I want to get here is that, number one, risk transfer through either a collective or through an insurance contract, a financial contract, is very important for the development of society and to support individuals in times of need. Number two, it starts typically with your high value items, large inventories for trade, ships for trade, moving on to homes, moving on to autos, moving on to satellites, moving on to other high-value items over time. So the breadth of coverage, if you will, the breadth of coverage begins to get broader and broader and broader as society accumulates different types of assets. So that's the development of property and casualty insurance. Now, brief statement about insurable risks. What is an insurable risk? I'll tell you something. Jennifer Lopez's legs are insured. It's not only your car, it's also Jennifer Lopez's legs. If she damages her legs and her income goes down, that's property damage. Her legs are insured. Now, that's kind of odd that I've got cell phones that can be insured. I've got satellites that can be insured. I've got ships that can be insured, and I got J-Lo's legs. Yeah. What are the characteristics that are behind all of these things? Right? What makes something insurable? The first thing that makes something insurable is that the risks diversify, right? What does that mean? That means if I'm insuring a car portfolio, one car, two cars, three cars out of 10,000 may get into an accident, but all 10,000 will not get into an accident in the same year. That means that you're going to diversify your risks. The larger your portfolio, the larger your diversification. Now, some of you that are working in AHEI are going to say, yes, that's true, unless there's a flood, right? If there's a flood like there was in 2011, then my motor book did not really diversify because flood damage impacted a large number of cars, right? So in general, property damage, motor accident it diversifies well. The bigger my book, the better off I am in terms of the risk per unit. But if there's a flood or a natural catastrophe, then like a flooding in 2011, then I could have many, many, many cars at the same time. Now, the funny thing is that here in Thailand, it may not diversify. You may have an accumulation of risk, automobile flood risk in Thailand. But if you take Thailand and put it next to earthquake in California, you put it next to fire or storm damage on the Gulf Coast, you put it next to forest fire damages, earthquakes, etc., and so on across the globe, and it diversifies. Why? Because in 2011, yes, Thailand had bad floods, but you didn't see that big of an earthquake hit in the rest of the world. So risks diversify. It's just a question of how big your pool is, okay? But the key is if you're going to insure the risk, they have to diversify. Now, why does Jennifer Lopez's legs diversify? Well, there's only one Jennifer Lopez, and if I put her legs into a bigger pool, it's not likely that everybody's legs or everybody's car or everybody's commercial business is going to get hit at the same time, right? I would suggest that Jennifer Lopez tripping and falling and damaging her legs is going to be a unique event without an accumulation risk across other insured risks. Now, the second thing is the losses have to be identifiable. Yeah? And that's because insurance indemnifies. What does indemnification mean? Insurance means I will try to make you whole. I will try to compensate you for your financial loss in the event of a loss, right? And so there needs to be a loss. I need to be able to measure the loss. For a home, typically it's, for example, the replacement value. How much does it cost to replace the home if it's a full limit loss in terms of a fire? So I need to be able to calculate how much of that loss, when did it occur, and what was the cause, right? And why? What was the cause? Because if the homeowner fires his own house and burns down his own house, I don't want to insure that. And I'll get to that under Section 3. But the loss has to be, the cause has to be determined. The time and place has to be determined. Now, why is this important? Let me give you an example. In 2011, also, we had, September 11th, during the 1990s, we had the Twin Towers, a major terrorism event in New York. We had two towers, the World Trade Center. Plane comes in to one tower, takes it down. Plane comes in again, another tower, takes down the second tower. Now, the insurance contract there says we will cover one event and only one event. And it took them 5 years to determine whether each tower was an event or whether it was the same event. So the actual timing of the loss and the definition of what is a loss is actually critical for this. Let me give you another example. If somebody is writing natural catastrophe insurance, typically it will be for storm damage within a 24-hour period. Now, it could very well be the case that in Florida, you could have one storm coming behind another over the course of a week. But the insurance only kicks in on that first storm, not on the week. So the time and the cause is actually critical for determining how much is payable in their insurance contract. Now, the third point, I said you may have a problem if the homeowner burns down his house, right? These losses that are an insurable loss has to be accidental, right? It has to be outside of the control of the individual, right? And if a homeowner burns down their house, they caused it, I'm not going to pay, right? Why? Because you've got something that is called moral hazard. And moral hazard, if I'm doing this correctly, moral hazard down here, that's the word. Moral hazard is the case where, as an insured, my behavior can impact the outcome. Now, let me give you a common example, an uncommon example, but one that I hope that you understand. Clearly, I'm not going to pay on a homeowner's policy if the homeowner burns down their house. Forget it, not going to do it. Suppose a more nuanced case. Suppose a 25-year-old guy gets a Lamborghini from his dad, right? And he gets an insurance. And he gets the full cover, the sweet package on insurance on this. Do you think as a 25-year-old guy who anyway is a worse driver typically than a woman or an older person, etc., you think that this person may take more risks in his Lambo now that he is fully covered in insurance? Do you think that he may actually hit 200 kilometers an hour going to Pattaya for the weekend, right? Why not? The car's a Lambo. Let's do it. And he's fully insured, right? He's fully insured for property and for liability. This is the case where insurance may affect the behavior of the property owner. Let me give you another case. Suppose I'm a factory owner here in Bangkok. I own a factory, and I decide to buy fire insurance. What is my incentive to put in sprinklers? Right? What do I care? I'm insured. Why would I put in fire doors in order to prevent my loss? I'm insured. Another case where the presence of insurance actually affects my behavior, and I can increase my losses simply because I have insurance, right? Now, there are ways around moral hazard, and you see some of them down here, right? Deductibles. If the Lambo driver has a deductible of 2 million baht, so the first loss of 2 million baht is on them, or 5 million baht. I mean, heck, it's going to be a 40, 50 million baht car, right? But let's suppose that it's the first 5 million baht is a deductible. One would assume that they're not going to go too crazy. So there are ways to make moral hazard change, and that's the role of deductibles. That's the role of coinsurance or copay, policy limits, etc. Now, the final thing is, and you saw that in the example, the final thing is that the insured loss has to be meaningful enough that they're willing to insure it. So I am not going to insure the loss of a pair of shoes, right? I'll go out and buy a new pair of shoes. If I lose them, if they get damaged, I'll go out and buy a new pair of shoes. I will go out and I'll look around for insurance for my house, because if my house burns down, a substantial part of my wealth burns down. So it has to be meaningful. These are insurable risks. And do J-Lo's legs fit into that? Yes. They diversify. Let's face it, she's on TV. If she falls and breaks her leg, I can determine the time and the place and the cause of the accident. The loss should be accidental, because I don't think J-Lo has wants to damage her own legs. That would be perverse. And it's a meaningful loss, because if she can't dance anymore, then obviously it's meaningful to J-Lo. So J-Lo's legs are an insurable risk. Now, these are examples of insurable risk in property and casualty. Property is for the loss or damage to property, autos, ships, homes, satellites, factories, crops in the field. Crops in the field are an asset, etc. And on the other side, liability or casualty insurance, property and casualty. Casualty is not the indemnification for property losses, but damages if you are found liable. So if you are responsible for somebody else's loss, then that's when casualty or liability insurance comes in. And the most common form of liability insurance is third-party automobile insurance, right? So mandatory third-party automobile insurance makes sure that the driver, if they get into an accident, they have sufficient coverage to cover the other party's damage. And I'll explain why that's the case moving forward. But you also have liability insurance for construction defects, for pharmaceuticals or other manufactured goods, et cetera, and so on. Now, what are the benefits? The benefits to policyholders are reasonably clear. If I am willing to pay a premium that seems reasonable given the amount of risk I think I'm giving up, right? And so the risk has to be large, the premium has to be small in general, but if we can find a meeting of the minds where the premium seems reasonable to the policyholder relative to the risks that they're giving up, the risk of loss of their home, the risk of loss of their car, etc., then it benefits policyholders, right? Makes them sleep better at night, right? To shareholders, as long as you're pricing it right, you can actually get a lot of the benefit from the diversification, right? So if I have a large enough pool and I'm pricing it right, I can make a decent return on capital. And the return on capital for the P&C, for many P&C companies, you can get up to 15, 16, 17% return on capital. And that's attractive for shareholders. Now, to society, it's good. Why is it good? Because private insurance associates the cost of bearing the risk with the person responsible. So if you take a look again at third-party motor liability, Thailand, it's mandatory. Many countries, it's mandatory. Everybody has to have third-party liability. So once you get into a car, you need third-party liability such that if you cause an accident, the person gets covered for their medical expenses, for their property damage, for whatever, because if you didn't cover it, then society would be expected to cover it, right? So if they had a whole bunch of drivers out there without third-party liability and they're hitting lots of people, Thailand has I think the worst car traffic fatality rate in Asia. I think it's the 9th worst in the world, right? If none of those were insured, then what would happen is the government would have to pick up a lot of rehabilitation expenses, a lot of expenses. At least private insurance puts the cost of the risk onto those that are actually causing the potential risk. And that's good for society. Now, let's talk a little bit about the economics. And I'm going to use a cash flow diagram here. Okay? And what is this diagram? This blue bar here represents premium, and I receive premium up front. So this axis here is time, over time, maybe years. This is, the height is money that I get, and if it's below the line, it's money that I pay out, right? Now, at the beginning of the policy, I may receive my premium, but I have to pay acquisition expenses. So I've got premium minus acquisition expenses. That's my cash. Over time, I am expected to pay claims. Now, the claims may be longer term than 1 year, 2 year. Although property and casualty is typically a 1-year business, I may be paying claims for 3 years, 4 years, 5 years. Let me give you an example. Under motor liability in many jurisdictions, if there's an accident and another person is injured, I may have to pay that person an annuity. I may have to pay that person for the rest of their life, right? That means that an accident that happens in year 1 could cause a cash flow or a claims payment for the next 30, 40, 50 years. Now, these claims payments are dependent on car accidents, on home fires, etc., and so on. So this is cash in, premium, minus acquisition expenses. Cash out over time, claims and the claims development. Now, I'm sitting there with a bunch of premium. Obviously, what I'm going to do is invest it. So I'm going to invest that premium such that I get the principal back at the time I need to pay claims, right? So typically, I'll take that residual that I earn and I'll invest it in fixed income bonds such that I can pay my claims over time, my expected claims over time, right? And I may actually put a little bit of money in risky assets, right? Such as public equities, REITs, etc., to try and get a little bit more juice out of my investment portfolio. And hopefully that's enough cash flow that I'm generating from the premium to cover my future claims in the future, right? So cash in gets split into an investment portfolio and fixed income typically to cover the claims that I need to pay in the future. Now, unfortunately, my best estimate of claims is oftentimes going to be wrong. And in 2011, I believe that's the year when the Thai flooding happened, it was horribly wrong, right? I think Allianz lost between 250 and 300 million euros due to Thai floods during that year. So that's a lot of capital, right? You're not going to make that up out of premium, right? There's no way, right? So you need to hold capital for any uncertainty of the claims, right? That's the basic economics, right? You hope that the capital stays there. You hope that you're not surprised But if you are surprised, you have enough solvency in order to cover people, your policyholders. Now, what do you want to do with this? You want to make sure that your premium is sufficient to cover claims, expenses, and return on capital. That's your technical profitability. Remember that circle that I showed you? Underwriting results, expense results, and investment income. So you want to make sure that your premium is sufficient to cover that, including your operating profit, which includes investment returns. The next thing you want to do is you want to make sure that your capital that is required to cover claims uncertainty is appropriate, that you're not holding too much capital and you're not holding too little capital. Now, the good thing about property and casualty is that the actual it's as single year business, and it can be repriced in single year, with the exceptions of Nat Cat, etc. The capital tends to be reasonable, because ultimately what I want to do is I want to take operating profit, divide it by the amount of capital, and come up with a return on equity. And a higher return on equity is better, right? So I want to get good profitability through expense management, ALM, and underwriting. I want to get good enough profitability such that I can essentially get a good return on capital. Not too much capital, not too little capital. So in general, the return on capital can be very good, but for a life and health company, it tends to be a little bit more challenging. Now, if you think about the story that I just told, operating profit driven by claims underwriting, expense management, and investment returns, capital intensity managed appropriately, this looks like my virtuous cycle that we started with, right? So we're completely back to the beginning. I need to put premium relative to claims and expenses such that I am earning a profit. I need to do a reasonable investment management to earn my investment income. That allows me to generate a return on capital, say 13%, 10%, 15%. And then I have to decide, what do I do with that capital? Do I plow it back for further growth? Do I give it back to shareholders? Or do I strengthen my reserves? Do I strengthen my capital? That's managing insurance in a nutshell. That's the economics of insurance. Now, I want to show you something, how you can find this in our financial statements. This is Allianz financial statements taken from our annual report. And what you'll see here is you'll see many of these things. So premium, which is the top line, right? And that's a big number. In 2017, it's 47 billion euros. Well, there's my investment result. And then I've got down here, I've got claims and acquisition and expenses, right? And so that looks like all of the cash flows that I just talked about, right? If you go back to my cash flow diagram, I've got pretty much all of the cash flows that were on my diagram, pretty much all of them, except for I've got this bizarre thing that is essentially these two elements, fee and commission income and fee and commission expenses, right? Now, the group is special. You will not see this high of fees and commissions on AAGI's income statement relative to premium, nor will you see them offsetting in that manner. This is interesting because for Allianz Group, let me give you an example. Allianz AAGI reinsures to the group. And because we reinsure to the group, Allianz Re earns fees and commission, right? And in this consolidated view, what you're seeing is that all of the operating entities that are reinsuring to Allianz Re, that income, that fee income, that goes to Allianz Re. But who pays it? The OEs, right? And that's why they're pretty much net. They're pretty much net because we retain most of the risk within Allianz. And so the only cash flows here in this financial statement that differ from that simple diagram that I showed you earlier is really this fee and commission income And that's due to the unique nature of Allianz Group, where most, if not all, of the insurance from the operating entities goes up to Allianz Re. Otherwise, you can readily identify technical underwriting profitability, premium minus claims, minus reserve runoff, minus acquisition and admin expenses, right? So that's my technical underwriting profitability. That defines my combined ratio. If you go down here, you see that technical profitability is premium times 1 minus combined ratio. Combined ratio is your loss ratio, or loss ratio is your claims divided by premium, and my expense ratio is my expenses divided by premium. So as long as my combined ratio is less than 1, I'm making money on technical underwriting. That's a good thing, right? So combined ratio less than 1 is good. And you know this from your health business. You know this from your P&C business. Then the other cash flow in that simplistic diagram was my investment result. And I said that these were materially all of the cash flows in that diagram, and even in my virtuous circle, except I'm missing something. What am I missing? I'm missing the view on capital, right? So if you remember the diagram, there was capital that needed to support the uncertainty of future claims. I had premiums, I had expenses, I had claims, but I also had capital, right? And why is that important? Because all of this stuff up here, this defines my return, and I need a return on what? A return on capital. So what I've done here is I've added capital intensity. At the time back here, Allianz was holding about 42 billion worth of capital against this premium, against this book of business, which related to approximately a 9% return on capital. There you have it. Generate operating profit through good underwriting, expense management, and investment returns. That generates a return on capital, and then you have to decide, what are you going to do with that capital? Are you going to give it back to shareholders, or are you going to grow the business? That was our virtuous cycle, but I think we went back to an old version. Okay, so that's property and casualty. Now, the one thing that I want to say is the following. There are two interested parties in the detailed financials, in understanding what's happening with expenses, what's happening with claims, etc. One party is obviously our shareholder, which would be Allianz, right? Allianz cares quite a bit about what's happening. And that's why we generate a lot of additional statistics to help them understand whether we can create sustainable value. So in terms of technical underwriting profitability, we talk about our loss ratio, our expense ratio, our runoff ratio. We give additional guidance with regards to natural catastrophe, average or normalized runoff, etc. So we're providing more information to our primary shareholder, Allianz, such that they can get a feeling for whether or not AAGI is creating value. And these translates into KPIs or key performance indicators, such as details into the loss ratio, expense ratio, accident year loss ratios, nat cat contributions, etc. So there's a lot of reporting that goes along internally. Now, who else is interested in the performance? It's not just the group, but it's external stakeholders. So our shareholders, when they are valuing Allianz as a group, they are trying to look at and come up with an estimate of our forward-looking profitability. And they're looking at history here in order to project out the future, because shareholders care about future profitability. And they're trying to get as much information as possible about our technical underwriting profitability, our investment profitability, and our capital needs They're trying to get as much information as possible so they can accurately predict 1 year, 2 year, 3 year profitability and return to shareholders. This is an example here of what we distribute, what we disclose to the public. And we actually disclose to our shareholders quite a bit of information. Why? Because like Aaron Fryer in ASUP, the CFO in ASUP, representing the shareholder and trying to understand whether or not our business is sustainably profitable, our overall shareholders listed on the DAX in Germany, they are also very concerned with projecting out and understanding, will we be profitable in the future? So we provide as a group a lot of different KPIs to the public. And I'll tell you, if you talk with Lars Schmidt and Poe, you'll see that we provide a heck of a lot of statistics and a lot of forecasts and a lot of projections to our shareholder representatives in ASAP and at Group Actuarial Planning and Controlling. Now I'm going to skip this. I think this is interesting. You saw some statistics about our expense ratios and our loss ratios. We also provide quite a bit of information about our operating results in terms of investment returns. And what I want to draw your attention to here is that in the P&C segment, it's all investment income, and there's very, very little capital gains. Now, why is that? Right? Why is that? That is because, and if we go down here to this analyst quote from Morgan Stanley, for P&C companies in particular, Morgan Stanley says, we estimate normalized returns, that is the returns that we expected to achieve over the cycle, allowing for average investment returns and eliminating capital gains, right? So even if we had tremendous success in public equities in our P&C portfolio, Morgan Stanley is saying they would take out those capital gains. They would ignore them. They're not going to give you any value for them. Even if we were tremendously successful in taking capital gains in our REIT portfolio, our real estate investment trust, Morgan Stanley is saying, fine for you, wonderful, wonderful, but I'm going to eliminate those when I value your company and your cash flows. Now, why is that? That is because investors would rather have the capital back for them to invest in public equities, in publicly listed REITs and mutual funds. They're the investors, right? They want us to focus on what they cannot do. What investors cannot do is generate good technical underwriting profits. Investors cannot do that. Investors can invest in equities. Investors can invest in REITs. Investors can invest in infrastructure. This is what investors can do, right? What we do and what makes us special is not investment, but really, and no offense to Kunsurjak, I think he does a fantastic job. It's just that analysts don't value investment, capital gains. They eliminate them. They take them out. I say, I'm going to ignore them. That means that, and this helps to explain why the bulk of our portfolio of assets in AAGI are in fact fixed income, right? Because any capital gains from real assets are going to be ignored in terms of operating profit by the group and by analysts. Now, why would investors rather have that capital back? They would rather have the capital back because, number one, they feel that they are pretty good at investing and probably better than we might be. They have egos, right? So they probably feel that they're better than we are in terms of investing in public equities. Number two, if we make a capital gain, we're going to pay an income tax. Once we get the money to shareholders, they have to pay a tax on dividends. Any capital gains that are earned within our insurance company are taxed twice to investors, once at the company level and once at investors. If ultimately the investors just want public equities, it is far more tax efficient for them to invest directly than it is for us to invest and have the income taxed twice. So that's just an aside. Now, what do I want to say here? I want to go back to the original and reinforce this message. Insurance management is relatively easy. I do technical underwriting. I generate profit through technical expertise, through expense management, and through investment. I take those earnings and I decide what to do with them. I can grow my business. I can invest my capital by growing my business. I can return some to shareholders, or I can adjust my liquidity and or capital ratio. And I need to be not only good at technical expertise and expenses and investments, but also at sales and distribution, because anytime I want to grow, I need to grow profitably and have an effective sales force. And you saw that through the income statement. You saw that through the numbers that we provide to shareholders, to the group, etc. Now, that was property and casualty insurance. And property and casualty insurance is relative to life and health pretty easy, right? Life and health gets a little bit more complicated, right? And why is that? That's because life and health are really two very, very different businesses. And it's not life and health. It's protection and retirement, right? Protection versus retirement, very, very different businesses. So let's go into the complexity of protection and retirement. Could I get a glass of water? Thank you. Now, I'm going to go back and talk about protection. And what is protection? Protection is my life insurance, my pure life insurance. Forget savings, forget endowments, just life insurance that will pay a benefit to my children, to my spouse, etc. Or it's health. Protection is also health. So protection is payment against to replace income upon your death, or alternatively to cover your medical expenses, etc. That's life and health protection business. Now, originally in society would provide collective support mechanisms. I go back 10,000 years ago. 10,000 years ago, it's probably okay to assume that if somebody died in a village, their husband or spouse, their wife, their children, hopefully the village would help take care of them. That's in some sense a collective life insurance policy, right? You actually began to see life insurance policies initially, more financial contracts, if you will, being developed for on the life side. For example, the burial clubs for Roman soldiers. So about 100 years BC, if you were a soldier, your probability of dying is pretty high. And in Roman mythology, in order to get across the river into the next area, the wonderful land there where you go when you die, you need to put 2 gold coins on your eyes and get in the boat and then go across the river, right? So it takes money. It takes money in order to pay your way into heaven, if you will. And so life insurance, where you had a lot of people dying, started out in some sense with the Roman military, which would provide life insurance, for Roman soldiers. Then around the 1600s, you began to have guilds. Guilds were associations associated with trades, with skills. So you would have a guild which was for iron workers. You would have a gold workers guild. You would have a guild of butchers, right? And all of the butchers in the area would get together and they would have a nice big guild house. They would try to regulate how much business gets done, what are the prices, et cetera, and so on. and they would try and, as a group of commercial people with the same interests, they would try to support each other. Well, guilds oftentimes offered benefits to surviving family members of guild members that died. This is the analogy to group life business and group health. So guilds as a collective would actually cover the risk of a guild member dying and leaving their wife and children without income. Now, you began to see contracts which were not associated with collectives a little bit later. And here in 1752, you see the first mutual life insurance, Equitable of London, that actually used age-based pricing and the first actuary to actually value mortality insurance, right? And why was that? That was because income for surviving family members, such that wives and children could continue with a reasonable life after the earner died, was very, very important. Now, what is interesting here, besides the development, is this one over here. This is kind of fun, right? In 1774, the English government said that in the Life Insurance Act, that the purchaser of life insurance had to have a legitimate interest in the insured. Now, why was this interesting? This was interesting because as mutual companies came up in 1759, etc., so suddenly you had insurance. What would I do if I was a bad person? I would take insurance out on that guy over there, who I don't know. I don't know that guy. I would take insurance out on that guy. I would follow him home on a dark night, have him killed, and collect the policy. And that's exactly what was happening. What was happening was that they were noticing that the problematic death rates for people that were insured were increasing, and that oftentimes the people that took out the policy were the people that were doing the killing. Now, health programs came in. I found that kind of interesting. So that's why you have you need an insurable interest in an individual before you can get the life insurance. So that's protection. And over here you see on health, the earliest health insurance analog, besides the guilds, the pure payment for insurance separate, that earliest health insurance was actually in the US, appeared in Washington State in the 1890s when lumber companies paid doctors to care for employees and provided care in order to reduce time off. So as an employee benefit, if you will. That was for healthcare. So a long history, maybe not as long as property and casualty, but a long history for protection policies. Now, I said that there's two different parts of life and health: protection and retirement. Retirement, I'll tell you, is relatively new. Oh, before we get to retirement, protection, if you take a look at the property and casualty cash flows, and you just replace the name with life and health protection, it's the same business, right? It is basically the same business. I collect premium, I've got claims. The claims now are due to here the claims now are due to not car accidents and homes, but to death and to illness, right? But it's basically the same economics. That's why we talk about combined ratios for employee benefits, health, and life. That's why we take a look at the loss ratios for our individual health products. It's basically the same business, right? Same economics, same things that you need to do. You need to generate operating profit through technical underwriting, expense management, and investment income. You need to make sure that you're managing these businesses at an appropriate capital level, but it's the same basic cycle. Retirement is a completely different business. Now, what is retirement? Retirement, this is an individual over time. Very good water. Thank you, sir. This is what happens in retirement. You're born. You grow up. You invest in your human capital. You go to university. You go to trade school. You work until you're too old and you have to stop working. Then you die, right? And so what you do is you accumulate assets in the first part of your life. You accumulate assets such that in your retirement, when you stop working, you can afford to live longer and you can afford to feed yourself. This is called the life cycle savings hypothesis. In the beginning, you invest in yourself and you work. You store up enough value such that you can retire in leisure in your old age. Now, how did this work? Let's go back 200, 300 years ago. Up to 300 years ago, retirement was based on how many children you had. For most people, the asset accumulation that happened was not accumulating cash or stocks or bonds. For most of humanity, the retirement basis for the future was essentially having children. Let me ask a question. Is there a technical problem?
It's okay.
Okay, very good. So 300 years ago, when everybody was sitting on a farm, when most people were sitting on a farm, your retirement, you didn't save up cash, you saved up children, and the children would then support you in your old age. Right? That's the way multi-generational families in Europe, in Asia, in Thailand, that's the way it worked. If you're in a farm, your store of wealth was not stock market and bonds, it was your kids, right? And so in an agrarian or a farmer-oriented society, security in the old age was provided by children taking over the farm, taking over the trade. There was limited mobility. You had multiple generations living together. So this is a common characteristic of most agrarian or farming societies, and even farmers that today, except for large technical farms. Now, what happened, right? There was a huge industrial revolution. About the 19th century, what happened was people went off the farms to work in cities because cities had steam engines. You didn't have steam engines in 1700, right? Everything was manual trades, manual farming, etc. 1800, I start to have the steam engines. I have power looms or weaving equipment. I have power manufacturing equipment. I have factories. But the funny thing about factories is factories are one location where there's a lot of capital, but I need to bring the people to the capital. So the Industrial Revolution that happened in the 19th century really changed this, because instead of people staying on the farm to take care of their parents, to take care of their grandparents in their old age, the youngsters were asked to go to the city to work in factories, right? To work where the capital was. And that meant that these people that would go to the cities, to go to the factories, to work in these factories, they would no longer have the social support mechanism. In the past, for farmers, your assets in retirement were your children. Your children are going to take care of you because that's the societal pact that you have. But if your children go to to where the capital is and start working in factories, they don't have that luxury anymore, and you don't have that luxury anymore. So this was a huge upheaval, right? The other thing is, in retirement, on the farm, you don't really retire, right? So you slow down, but you still work. You know, you're 80 years old, you still work in the kitchen, you still do things. So you never really retired. the life of retirement, there comes a certain point where maybe you can't work anymore in a factory. So you really have to plan for retirement after work. Now, in an industrial society, how did they replace this very strong need for retirement, right? Because factory workers are not going to have as many children. They're not going to have, they're going to be more mobile. They're not going to be able to rely on their children for their retirement. The answer is that companies offered retirement benefits. So the first retirement plans that were offered by employers in order to get people off of the farms and into the factory, right? And so American Express Railroad Company established the very first private pension plan in America. And American Express Railroad, that was, steam engine. You have to get the people to where the steam engines are in order to do that. And the only way you're going to get those people there is by offering them some possibility to retire, to have income when they retire. So whereas in an agrarian society, your retirement is through your children, in an industrial society, at the beginning, the employers had to begin to offer retirement in order to get the people from the farms into the cities. And what you see is private companies starting this. You see the employer, Otto von Bismarck, is typically said to have the first public pension, but it was really for his employees, right? So Otto von Bismarck in Germany was credited with being the first to have the vision of pensions for German public servants. And you got this after the age of 70. Now, it just so happened that people typically died before 65, so not a very good deal, but it's still, it's the employer, in this case, the German government, would provide a pension. In this case, even earlier, the employer, this was American Express Railroad, would provide the pension in order to pull people into cities. Now, ultimately, the benefits of employer provided pensions and the benefits of states providing benefits. Nobody likes to see senior people not having enough to eat, right? So pretty soon this practice was developed also for other people. So old age people that even not outside of their employers, you started to see governments here, the Social Security Act in the United States, public pensions, etc. What I want to say here is that in reality, the need for retirement products is 150 years old, no older than that. You saw in Property and Casualty that the need was 2,000, 3,000 years old, right? The need for retirement products or retirement solutions is relatively recent, about 150 years old. And it really started because of the Industrial Revolution, when people started coming off of the farms and you could no longer rely on your children in order to provide your pension. Now, what happened here is in the 60s and 70s and 80s, companies began to realize that company-provided pensions is not a core competence, right? So IBM, my dad retired at IBM at, I think, 60 at 1 times his actual salary. So he got a pension for life for 1 time. You're not going to find that anymore. There's no way you're going to get that 1 time to your final salary, right? And why? Because it's very, very expensive. And quite frankly, IBM is not the best provider of it, right? So IBM is not, they don't have that many actuaries there. They can't forecast it that much. It's just not a good proposition for a company. So not only is that corporates are not the best provider of long-term pensions, but it's too expensive in the forms that they had. And in addition, as we moved from an industrial to a service society, you needed a portable pension. You needed something that would go with you, right? Because in the past, if I started working with Wells Fargo or with the government, I would I would retire with them. But now, with people changing jobs more frequently, et cetera, and so on, you need portability. So for 3 reasons, employers are no longer the best position to provide retirement solutions. And that's when insurance companies come in, retirement providers, our endowment products, our investment products such as unit links. These are all retirement solutions, if you will, to help people accumulate assets such that in retirement they can retire and at a good income. Now, we're facing another period. So right now, I would say 10 years ago, 15 years ago, insurance companies had a great advantage in terms of retirement solutions. Nowadays, we've got competition and severe competition. Our competition is with asset managers, right? So we've gone from the period where employer provides it to a period where retirement companies are strong. The new zone is where asset managers are competing with us for retirement savings. Why? Because people are moving away from defined benefit to defined contribution or to investment products. People are becoming more financially literate. So people are now thinking ahead and saying, how much fixed income, how much equities do I think I can have when I turn 50 or 60, such that I can retire, so that I can continue to live my lifestyle when I'm 80. So people are more financially literate. People are more responsible for their own retirement and their own savings, and capital markets are filling in the void. So right now, I can get a mutual fund of fixed income, I can get an index tracking fund for equities, and I can put together my own par portfolio, more or less, my participating portfolio. So with lower cost transactions, more financial literacy, and more responsibility on the saver, you're going to see an increased emphasis or competition with banks, with security firms, etc., in the retirement space. The point that I want to get across here is that retirement products, in comparison with protection products, are relatively recent, and they were developed simply because of a major change in society away from the agrarian society towards the industrial, and even then towards the service retirement, service economy, etc. Now here, the economics are similar but slightly different, right? So again, I collect premium up front, and then over time, I may make transfers, or I may credit their account with a guaranteed amount until I pay back at the end of the policy their principal for a retirement product. Call this an endowment product. Now, in the meantime, I'm going to take this premium less acquisition expenses, and I'm going to invest it in fixed income such that I can basically match my claims, what I owe to the customer. But I may have a little bit of extra risk-bearing capacity available, and I may actually participate in the returns. So what I may do is I may take a little bit more risk. And this risk is, the risk is interesting, because if I earn more than what the policyholder expects, then I get to keep it. And if I earn less, then I have to pay them, and I have to honor the guarantee, right? So similar to P&C, but a little bit different, because now I'm really going to focus on retirement products on the risk taking. Now, if the policyholder participates, and these are our par products sold through the bank and through our agency channel, our participating products, if I earn extra here, get a little bit of a kicker above my fixed income, call it from public equities, REITs, etc., infrastructure, then I'm going to give some to my policyholder as well. So I'm going to give some of that to my policyholder, and then if I really make a lot of excess, I'll keep some for myself, and that is the shareholder participation in the investment fund. So the policyholder gets a certain participation, and the shareholder gets the remainder. I still need capital, because my actuarial projections may be wrong. I may have mispriced my product, et cetera, and so on. So I need some capital as well. Same basic structure, but now the attitude and the philosophy is slightly different, right? If you go back 10 years ago, when the interest rates in Thailand were 4 or 5%, I will make you a bet that the strategy was relatively simple. The strategy was to say, okay, let's set our guarantees at government bond rates minus 80% of government bond rates. So if the government bond rate was 5%, I'd set my guarantee at 4%. I'd invest a certain amount in the government bonds for yield, but then I would invest more money in equities, real estate, and other risky assets. And the attitude was, if I set my guarantee at 4% and I'm getting 5% on my government bonds, you know what? In the long run, equities are going to be good, real estate's going to be good, so I don't need to worry about it. I'll get a little extra kicker. I'll get a little extra participation, not only for policyholders, but also for myself, right? And I guarantee you, this was the strategy 10, 15 years ago in Thailand. It was the strategy 10, 15 years ago in Europe. Standard pricing policy 15, 20 years ago in Europe was take your government bond yield curve, discount it a little bit, that's your guarantees. A 5% government bond means a 4% guarantee. Invest 20% in public equities and REITs, etc., and you're off to the races. In the long run, you're going to make money. In the long run, you're going to make money. Now, what is the principles? And very similar. The premium is invested to cover guarantees and expenses and generate investment returns. Excess returns are shared between the policyholders and the shareholders. Shareholders are responsible for any underperformance, but don't worry about it. These are long-term contracts, and in the long run, equities and real estate are going to outperform. Wonderful returns, wonderful returns. The main sources of risk are an inability to meet the guarantees due to capital losses on real assets and credit losses, or reinvestment risks, which are reinvestment rates which are too low. So if I have a 30-year endowment and I promise a 4% guarantee 10 years ago, rates have gone down, right? Right now, the 10-year rate is at 250. If I have to reinvest, I've got a problem. I'm missing about 1.5%. So you see the risks are coming from an asset liability mismatch. I'm promising a guarantee, but I'm actually investing in real assets and at a shorter duration than my guarantee. And as a consequence, the bigger my mismatch, the more capital intensive this business is. So if I decide to invest in 10-year bonds, but backing a 30-year guarantee, that's a huge risk. If I decide to back a 30-year guarantee with 60% public equities, that's a huge risk. And therefore, I need more capital. I may expect to get more return in the long run, but I need a lot more capital. So capital is really the driver of life and health savings products. Now, what are the economic rationale for life and health products? For protection products, mortality, health products, etc. It's basically the same proposition as for property and casualty. The insurance company gets technical profits if appropriately underwritten, and the insured gets protection against what they consider to be a reasonable premium for health, for disability, for death, etc. Now, retirement, it's a little bit different. What do the customers get? Why go to a life retirement product as opposed to a bank or someplace else? Typically, it is because there's a little bit of protection. In every one of our endowment products, there is a sum assured. You get some life protection. Insurance companies are the only ones that give guarantees. Asset management companies will not guarantee you anything. They don't have a balance sheet. We have a balance sheet, we can give guarantees. Finally, tax benefits. The customer gets tax benefits. The government allows, here in Thailand, I believe, if you lock in a savings product that forces you to save for the next 10 years, your contributions up to a certain amount are tax deductible. So you get a tax benefit. So instead of going to a mutual fund, if you go to Allianz Ayudaya, AZAY, you get a tax benefit, you get a certain level of guarantee, and you get protection. You get some assured. That's why over there, this is why what your customer gets and why they would go to us as opposed to a mutual fund. Now, what are the economics for us? The economics for us for protection, just like property and casualty. Under retirement, you've got two different classes of products. You've got asset management-like products, and I've got guaranteed products. Asset management products are unit-linked, right? Let's call them unit-linked. You could call them fixed income annuities, variable annuities, but essentially, the asset management-like products, like a unit-linked, there are no guarantees or very, very manageable guarantees, no guarantees, and the insurance company gets fee income. We get fee income, right? But we get a little bit of protection income because there's a little bit of protection in the product, but we get, mostly it's a fee-based business, just like an asset management product. For guaranteed products, really, it depends on how much risk you take. The more risk you take, the more investment income, but then the more capital you need to hold against that. And in retirement businesses, capital is what kills retirement businesses. Unit-linked has very limited capital requirements. The capital required for guaranteed products can be very, very high, depending on the mismatch down here, depending on the mismatch. If I have a 30-year endowment and I invest in 10-year government bonds and 50% equities, I'm going to have to hold a lot of capital against that. And so my return on capital is going to look very challenged, very, very challenging, right? So this is the economic rationale from the insurer's perspective and the insured's perspective. Ultimately, though, you see the same thing. I create value through technical underwriting, expense management, and investment management. Once I generate that profit, and hopefully that return divided by the capital that I use is going to be attractive. And then I need to decide how much am I going to grow? How much do I give back to shareholders? And whether or not I need to adjust my capital ratio to strengthen my balance sheet. But I need good technical underwriting, I need good expense management, I need good investment management, I need good capital management, I need great sales and distribution to grow my business. Now, wow, this is a little bit dense. If you remember correctly, I showed you the financial statements for Allianz for the P&C company. I'm going to show you now the financial statements for the life and health company, but I'm not going to show you the IFRS income statement. I'm going to show you a supplementary information that's available to shareholders, to everyone. And it's called a sources of earnings report for the life and health company. And why is this? Why am I going to show this? Because for the life and health business, because of retirement products, your income statement, your accounting income statement means absolutely nothing. right? Claims include endowment products that I wrote 15 years ago, right? And so if I want to understand what is the economics of the business, I have to be able to go back and say, how much did I lose on that 15 years ago business when I offered a 5% guarantee? How much did I make or lose on that? I can't tell you that when I look at my income statement, because all I see is that I paid out the principal on these 15-year endowment products that are maturing. You really have no idea what's going on in the income statement of the IFRS income statement of a retirement business. Of a protection business, fine. It's a lot closer to a P&C business. You get some idea. But for a retirement business, it's virtually impossible. So what do? We provide a financial supplement, We provide an earnings statement, and I apologize, this is so small, a supplementary earnings breakdown, sources of profitability. And the sources of profitability, you see the top line is loadings, which is basically fee income, if you will, right? So it's basically fee income, it's margin income. Then the next line down there, the next big line is investment margin. How much return on investable assets that I get to keep after paying for the guarantees, after paying for everything that the policyholder gets, right? Then the next line is expenses. And the next line is technical margin. And the sum of those, if I'm not mistaken, the sum of those gives me operating profit. So instead of looking at premium minus claims minus expenses, what I'm going to do is I'm going to say, I make money through loadings and fees. I make money through excess investment returns above the guaranteed rate. I have expenses, and I also make money through my technical margin on all of my protection, my life protection, et cetera, and so on. And what I think is interesting here is that if you look at the investment margin row and compare it to the operating profit row, you'll see that the investment margin for all of Allianz Group's life and health business, the investment margin is 96% of operating profit. What does that mean? That means that Allianz Group is predominantly a retirement business, right? That's what it means. Predominantly, we are a retirement business. 96% of our profitability comes from the investment margin. The rest is just a wash, right? That's pretty interesting. And you see in the table next to it, over here, if you can see it, and maybe we distribute this in in PDF form later on. But you can see that the investment margin is calculated as investment returns minus guarantees, minus policyholder reasonable expectations, minus investment expenses, and the rest is what we get. The rest of the investment income is what we get. Now, I think this is interesting because the group, 96% of our profitability is due to investment margin, which is predominantly focused on endowment products, on retirement products, not on protection, right? In fact, in the protection line, the technical profitability is only $1 billion, and quite frankly, that nets out with fees and expenses. So it's the net contribution is relatively small. This is in contrast to Allianz AZAY. AZAY has a significant part of our profitability. Our P&L is due to technical profitability because we rotated more towards a health orientation some years ago. Now, what you can do is you can also see the same figures, but for different categories, right? This first column here, these first columns are the sum of guaranteed business, hybrid guaranteed business, protection business, and unit linked, right? So if I take my unit linked business plus my protection business plus my retirement savings business, I get the total. And if you look at the unit linked business, I claim that unit linked business is essentially an asset management like business. And you look at it and you see that you see a couple things. First of all, you see that the loadings and fees, the fees are a material part of the income, right? And the fees being higher than your expenses deliver your income. And if you look in here, there's very, very little investment margin. There's virtually no investment margin. And there's also very, very little technical result, right? So this basically shows you that unit linked are like an asset management business. I get fees, I have expenses. I don't have that much at risk in terms, I don't invest the money for my own account, so I have very limited investment margin. And yeah, there's a little bit of protection in there, but not that much, right? So really, unit linked business is driven by fees minus expenses. Now, let's go to protection businesses. You look at protection businesses, and you look at the big contributions there, and you'll see, this is very, very difficult. You'll see that the investment margin is reasonably small. It's all I'm doing is getting some investment return on the capital that's backing it. The bulk of the profitability is actually down here in technical margin, right? That's where the bulk of that's my underwriting result. That's my underwriting result before expenses. And then that is materially what is driving my operating profit. And if I do a what if combined ratio, etc., you'll see that the implied combined ratio is 93.7 for my protection business. The implied expense ratio is 19%, and the implied loss ratio is 74%. So this is fully consistent with the story that I told earlier. Protection business is like a P&C business. You don't get that much investment income, and the bulk of your profitability is going to be driven by your technical margin, right? Unit linked is asset management. It's a fee-based business. Not much risk, not much investment. Protection, that is like a P&C business that is risk-bearing. You don't have much investment income. And if you've got good technical underwriting skills, you're going to make some money. You go here, however, for savings and investment. And savings and investment, the investment margin as a percent of operating profit is above 100%. Okay? These are businesses, retirement savings and investment businesses outside of unit linked, capital guaranteed retirement savings businesses live off of investment income. It's as simple as that, right? So you don't have a lot of fee-based income there. You don't have a lot of protection income there. It's basically all driven right here. Oopsie. Oh, there we go. It's all driven by investment margin. That is over 100% of the total operating profit, which is interesting, right? So you think about it, and this is what makes retirement businesses this is what makes life and health businesses so complex. Number one, I've got protection versus savings. And even within savings, I've got such radically different products. I've got unit linked, which are asset management driven, and I've got guaranteed businesses, which are different, or fundamentally different. They're different in terms of where you get your money. Is it from fees or is it from investment income? In addition, as you'll see, they're quite a bit different in terms of the amount of capital that you need to hold. And let's speak about capital just for a second. This shows the breakdown of the capital that is required for each of our segments as a group: property and casualty, life and health, a corporate and other, which includes asset management. And you see there, so this is this row is life and health, and you see that the amount of capital that we need to hold to support our life and health business is, I think, the highest of any segment, right? And so it's 24 billion in 2000 and whatever that is, 24 billion, which is much higher than P&C or corporate and other. So we need a lot of capital. We need a lot of capital for our life and health. And the next obvious question is why? Well, let's take a look at the capital columns, right? I have market risk. I have credit risk, which is both of these are associated with endowment products. They're associated with retirement products. Then I have underwriting risk, right? And out of that 24 billion, underwriting risk represented only 600 million, if it looks like. About 600 million. So in our entire life and health business, which requires 24 billion worth of capital in this year, the great majority of that capital is driven by investment risks, market risk, and credit risk, so due to my retirement portfolio, and an inconsequential amount is being driven by my underwriting risk, right? So you go back a slide and you say to yourself, where is the bulk of my income is coming from investment margin, so from financial investments. That's 96% of my total operating profit is coming from investment margin. That is being driven, or that investment margin is being driven by my retirement savings products, clearly not by my protection, not by my unit-linked products. And the amount of capital that I need to hold against that is substantial. The great bulk of the capital that's tied up is not tied up in protection or underwriting risks. It's other stuff, but it's also mostly market risk and credit risk. So what does this say? This says that financial risk capital at about 85% of total capital is huge, but it also generates a huge amount of the income. Okay, so let me just say this. You saw that it was about 96% of total operating profit, but it generates about, 80+% of the capital requirements. Is it a good business? Right? So a large amount of the investment income, but also a disproportionate share of the capital requirements. Is it a good business? Well, overall, if I was to take my life and health operating profit up above, and I was to divide it by the capital required at my solvency ratio of Solvency II, I would have gotten a return on capital of 7%. Now, does that sound particularly good? Right? Compared to what we should be earning? Probably not. That's not a great number, right? So yes, retirement products give you a lot of income, but compared to the capital that you need to support them, it doesn't look all that hot. Now, if you look at the protection business, and I compare the technical profitability from protection businesses, which is, I think, this row here, against the capital that is required for protection business, which I think is the underwriting capital, if I could do that comparison, I get 40% return on capital. Right? And so here's a lesson for life and health businesses. The lesson is you can't look, given the capital constraints for life and health businesses, you cannot look at earnings in isolation. You also have to look at the amount of capital that you have to put behind it. And this is a lot of capital, right? Investment income may be an easy way to make earnings, but on a risk-based capital regime where Solvency II is there and it's going to put a huge capital constraint on you, it's not an attractive return. On the other hand, protection businesses can offer a very substantial return on equity because the relative capital intensity is lower. Now, this should clue you in why Allianz has shifted in the course of the last 4 to 5 years to be very much protection, health focused in the life and health space. If you get it right, if you get the health business right, you can get a very good return on capital. You may not get as much top line. You may not get as much premium. You may not get as much investment income. But the quality of earnings in terms of the return on capital can be very, very good. And that's why this illustrates why, under risk-based capital requirements, why we have focused so much on health. Now, taking it up a batch. This is the same capital chart that you saw earlier. And now what I'm going to do is I'm going to compare it against the operating profit from the group, property and casualty segment, life and health segment, and asset management segment. And if I was to take the operating profits adjusted for COVID, and the red lines are COVID, if I was to do that and calculate the implied return on capital for the group, for the property and casualty segment, for the life and health segment, and for the asset management segment, you'd see radically different returns. So you could say to yourself, oh, look, life and health had 4.4 billion operating profit, bigger than property and casualty. Oh my goodness, let's go and party. Here we go. Yeah. Fantastic. I divide it by the amount of capital that's required, and it turns out to be a 6.8% return compared to a 14.6% return for P&C. Now, if you're a shareholder, are you kind of the go-go girls? Let's go for the higher top line? Or are you more of a person that's likely to say, look, if I'm going to invest for growth, where am I going to invest for growth? Am I going to invest for growth in P&C, or am I going to invest in growth in life and health? And I think it's relatively clear Allianz's strategy has been to improve the profitability on life and health before we start growing it like crazy, and to target growth more in property and casualty. And it's driven by the capital intensity of these businesses. Now, in order to reflect this, this is in our 2022-21 Capital Markets Day. You'll see a comparison in terms of ROE. The number of life and health units that were below the hurdle rate of 10% in 2015 versus 2021. We're communicating to the market that, hey, we're improving the profitability of our life and health businesses. We know that we have businesses that are not returning adequate return on capital, and we're improving it, and look at the progress. So we care about return on capital. We also showed, and during the Capital Markets Day, we show how we're doing this, how we're bringing, for example, the U.S. from below the group target of 13% to close to 20% return on equity through the major transaction that was done last year, a year ago, 2 years ago, in the U.S., a reinsurance transaction. You see how Germany has improved from at the group target to above it, etc. So we're really trying to communicate as a group that it's not only operating profit, which we care about, we also care about, for shareholders, we care about our return on the equity that we have invested. And we've got a program in place to improve the returns. And part of this is also because of the shift in terms of segments. You see in this chart the relative proportion of protection and health versus unit linked versus alternative guarantees, capital efficient guarantees, versus your old, really, really capital intensive annuities and savings businesses. Obviously, what we want to do and what we've done is we've taken down this and increased the proportion of preferred lines, specifically protection and health, unit linked, etc. So we've done a good job to reduce our dependence on high capital utilizing businesses. And what we want to do is also manage analysts' expectations with regards to future growth. We're saying that we are going to grow preferred lines, protection, unit linked without guarantees, and capital efficient guarantees by 6%, and we're going to shrink unpreferred lines by 3%. This is our story to the market, how we're going to get not only operating profit, but operating profit relative to the capital intensity of the business. And I think this should bring me full circle in terms of this. Managing the value of insurers is relatively easy. I need to generate profit, but profit is not enough. It is relative to the capital intensity of the business. And I need to make sure that my capital intensity is such that I am providing a good ROE, a good return on equity to the shareholders. And so we started this entire lecture with this circle. I need profit generating capabilities in terms of technical expertise, expense management, and investments. I need to be very, very good at capital management and understanding how I allocate my capital for growth. And if I can't grow preferred lines, if I can't grow profitably at a good ROE, I need to give it back to shareholders. I need the skills in terms of sales and distribution to make sure that I can continue to sustainably grow good, profitable business. And I think that does it. That basically concludes my presentation on managing the value for insurers, and we've come complete circle. We started out with this exhibit. We're going to end up with this exhibit. And now I think I want to give some comments with regards to development opportunities and personal development. First, I don't know. I guess we don't have the capability to take questions, do we? This is a question for you. We don't take questions, right? Okay, so we're not going to take questions. Your personal development. If you're watching this, I think it's absolutely fantastic because it demonstrates that you want to develop your own perspective and your own capital, your own human capital, right? So you personally want to develop, and I want to say thank you because by developing yourself, it's great to work together with people that want to develop themselves, that want to expand themselves and see new things and are intellectually inquisitive about new things. And it's going to make you better. This type of understanding is going to make you better. And that being inquisitive, that asking questions, I think is a tremendously strong attribute. If you don't ask questions, you'll never learn. So first, thank you for taking the effort to listen to me for the last 2 hours to talk about this, because it may not be germane, it may not be relevant to your daily job, but it still, I hope, gives you a broader perspective in terms of the company, its economics, and gives you some thoughts about broader issues within Allianz Ayudaya as opposed to just your narrow function. Second, take that same attitude and ask questions of senior people, of peers. Continually ask questions. Ask questions, why, for example, are we following this distribution strategy? Can you explain it to me? What is another distribution strategy better or worse? What about if we thought about the claims process in a different way? What would happen there? Asking questions outside of the way you do your daily business. Worst case scenario, you learn something, right? Best case scenario, you not only learn something, but you have an idea on how to improve something. You improve the claims management process, improve the cross-sell potential into customers, etc. An inquisitive mind that asks questions, just like you are today in today's session, is a valuable mind because it shows that you're not locked into you're a silo. It shows that you are thinking beyond the box, you're thinking outside, and you want to engage on potential things that have an impact for this company. And in terms of development opportunities, that type of an attitude, asking questions and engaging on broader issues and engaging in a conversation with your seniors and with your peers, it positions you incredibly well to not only learn, but potentially take on new responsibilities, project responsibilities, right? So if you demonstrate an ability to ask questions and to think critically and actually take the effort to ask the questions and take the effort to understand the situation, you're more likely to be considered somebody that is going to have the capability, but also the energy to lead a project, to lead an activity. In addition to actually taking responsibility and leading initiatives that may have higher impact on the company, you'll also come up on the radar of people of succession planning lists, right? So those people that are, in my experience, those people that are active in asking questions, in not necessarily challenging the status quo, but just asking questions and trying to learn, are typically better positioned to take project risks as well as to be on succession plans. So in terms of your personal development, keep doing exactly what you're doing today, right? Ask questions. There are questions from the participants. Okay, so there are questions from the participants. Okay, so this is my immediate thought on development. Keep doing exactly what you're doing right now, and that is be inquisitive, try to develop yourself, but just don't do it passively by listening to me. Ask questions, ask me questions, ask your peers questions, ask your seniors questions, because that's how you not only learn, but that's also how you get the exposure. By engaging in an intelligent conversation, you get the exposure to take a next step. Now, if there are some questions, and they're simple questions that my limited experience can manage, I'd love to hear them.
Okay, there's one question. What is the edge of Allianz to differentiate us from the competitors? Let's say if the health product is very profitable, why other insurers don't focus to sell health product too?
Right. That's a very good question. Our competitive edge is going to rest on three things. The first is that we put a lower emphasis on savings products earlier, and so we had to make the transition to health faster and earlier, right? And that meant that we were in a position to come out with better health propositions earlier than our peers. I would say some of our peers are, like, I don't want to name them, but some of them are only focusing on health in the last year and a half because they were bleeding so much on savings products that they had to stop the bleeding and replace the income. We've got greater experience. Now that means two things. We've got better experience, but we also have products that profitable products that as silly competitors come in, and I do think some of our competitors' products are silly, as they come in, we can manage our margin down. We still have a good profit margin. My personal view is that our profit margin is going to come under pressure due to competition, but that's to be expected. We can still keep a positive margin. The second reason is because I don't think we do silly things. I think there are competitors that because they're moving faster and they're trying to catch up and make up ground, and they don't have the type of international expertise and local expertise that we rely on, I think they're going to bleed a little bit, right? So let me give you two examples. So you've got an example of an as charged room product. I think it's Muay Thai Life, D Health, where they allow a standard room, as charged standard room under the policy. And that includes BDMS, that includes Bumrengard, that includes all of the most expensive hospitals. And those rooms can be 15, 20,000 per day, right? My personal view, and I think Sharon's and PP's view, product provider's view, is that this is going to be a nightmare. Because if you're given the opportunity to go to BDMS's flagship hospital at 20,000 a day in your policy, wouldn't you rather do that than go somewhere else, right? And why not? Because it's under the. So I honestly believe that some of the things that our competitors are doing are going to lead them into problems. And as another example, I think AXA came in hot and heavy, and in the last year they had to fundamentally reprice and pull back so much that they used to be competitors and strong competitors, but now they're not because they bled, right? So I think first, we moved earlier. Second, we don't do stupid things, and we do things that are long-term sustainable. So we don't do things we're not in and we're not, it's not a Katy Perry song, right? So you're hot and you're cold, you're in and you're out, et cetera, and so on. It's not like that. So sustainable products, sustainable pricing, sustainable strategy, and early positioning, I think, are what gives us an advantage. The second thing that I think gives us an advantage is we've got a great agency and direct sales force. I think that gives us a very strong advantage, because I'm firmly of the opinion that health is sold, it is not bought. So auto insurance, simple automobile insurance, it's bought. You can go and compare prices. You can go to comparison websites or other digital distribution. Increasingly, it's bought. It's a standardized product. Health is more complicated. And I think in order to sell, a strong agency force, a strong sales force that is focused on health and focused on profitable health is a tremendous asset, right? So I think we've got certain advantages that will take us for a while longer.
Okay, next question. How to manage unit link or investment under situation of inverted yield curve?
I don't think that's a good question, but and let me think about this. Under an inverted yield curve, they may have anyway. People are going to have more of an incentive to go short-term bank deposits, short-term paper in banks rather than long-term fixed income. That is clear. Now the question is, but most unit linked is not fixed income, right? Most unit linked is not driven by yield curve variations. It's rather driven by people's perception of the equity market, right? Now, it just so happens that an inverted yield curve historically has been a clear sign of a higher probability of a recession. So an inverted yield curve is typically associated with greater pessimism, right? And so unit linked in an inverted yield curve typically is unit linked when people are afraid of the equity markets. And unit linked tends to be more equity market geared. So it's problematic. And I guess the only thing I can say is that if you're in the single premium unit linked, and that is 50% of your business, you've got a huge problem, right? If you are in regular premium unit linked and it's 10% of your business, your problem's much, much smaller. And we're not there yet because we are only, in agency, we're only about 5 to 6% unit linked, all regular premium. So the strategy against an inverted yield curve or a pessimistic equity market is regular premium and or protection-driven products as opposed to pure short-term investment-driven products. So no single premium, try and get regular premium, try and get more protection into them. And I would still say that we need to get higher than where we are. Right now, agency is only 5 to 6% of total sales. We need to get it up to 10%. I think I have time for one more.
Okay. What are you most proud of the company so far?
A couple different things. First, great people, right? So I came here 2.5 years ago. I didn't know, I barely knew anyone. It has been very, very welcome. Everybody's been very, very welcoming. It's been a great experience. And I believe that we have great people, not only from a personal perspective, but also from a professional perspective. So I'm impressed by the level of professionalism. I'm impressed by the level of engagement. Very, very much impressed. I am proud that we are, for the last 2.5 years since I've been here, that we have always said our 3-year commitments are 3-year commitments. And I'm proud that we have not readjusted our planning dialogues down to renegotiate afterwards, right? So promise them anything and then renegotiate next year. I am proud that we've had the discipline to meet or beat and maintain our 3-year projection. And I think that has given ASAP and the group a lot of confidence in us, right? Because once we commit to something, and there are various things, whether it's the SDPD or whether it is actions with regards to portfolios. So for example, 1.5 years ago, I said to Anusha, we're going to boost up unit linked. We put in place the 12 by 12 in the MFA program, and we got unit link from about 1.5% of agency sales up to 5% of agency sales within a year. When we promise something, we're going to deliver, right? And whether our promise is the SDPD or whether it's unit linked, if we promise something, we're going to deliver on that because we deliver on our promises. And I'm very proud of the organization for actually doing that. I think it shows incredible integrity. So I'm proud of the people, and I'm proud of the culture in terms of delivering on what we promise.
Last question. What changes you'd want to see in Allianz next year?
I think that's an interesting question as well, right? The way I think about management is the following. I expect excellence at your day job, right? Then I expect 1 to 3 things that are going to, within the next 6 to 18 months, really change the business, have an impact, a meaningful impact on the business. So when I talk with my direct reports, I always say, you know what? I expect excellence at your day job. And quite frankly, excellence at your day job, I don't want to go through every single KPI of your day job, right? I expect good senior people to have excellence at their day job. And then I expect everybody to have 1 to 3 initiatives that are going to really turn the dial. And I can name the initiatives for each one of my direct reports, right? So we've got cost containment initiatives that Kunapa is delivering, as well as EB recovery. We've got under Kun Varong, we've got Franchise Builder, which has a tremendous potential to increase the value of our company. Under Kunchaya in non-agency distribution, we've got a tremendous new focus on lead generation, our own lead generation for direct marketing, as well as getting new bank assurance customers, as well as new direct marketing customers. And the list goes on in terms of what are the specific initiatives over a 6 to 18 month horizon that are going to turn the dial. So what changes do I expect for the next year? I expect great business as usual. And then I expect everybody to have 1 to 3 things that are really going to turn the dial, right? So I expect our telemedicine business to be a major component of our cost containment effort. Telemedicine under Kunid to be a major component of our cost containment within the next 1.5 years. We've got these initiatives, and that's what I expect. Nothing major. I do not believe that there'll be another large acquisition. I do not believe that there's not a rationale. We're a well-run company. It's not a rationale for another major restructuring, et cetera, and so on. It's really how do we maintain our excellence in our day job, and where are we going to really lever up in the next 6 to 18 months. Okay, I'm being told that it's time to end this. I hope you found it useful. I hope you found it entertaining. And I thank you very much for participating, and all the best.